The Great Recession was a global economic downturn that devastated world financial markets as well as the banking and real estate industries. The crisis led to increases in home mortgage foreclosures worldwide and caused millions of people to lose their life savings, their jobs, and their homes. It's generally considered to be the longest period of economic decline since the Great Depression of the 1930s. Although its effects were definitely global in nature, the Great Recession was most pronounced in the United States, where it originated as a result of the subprime mortgage crisis, and in Western Europe. A recession is a decline or stagnation in economic growth, but the economic indicators used to define the term recession have changed over time. Since the Great Recession, the International Monetary Fund, IMF, has described a global recession as a decline in real per capita world gross domestic product, GDP, as supported by other macroeconomic indicators such as industrial production, trade, oil consumption and unemployment, for a period of at least 2 consecutive quarters. By that definition, in the United States, the Great Recession started in December 2007. From that time, until the event's end, GDP declined by 4.3%, and the unemployment rate approached 10%.
The Great Recession, sometimes referred to as the 2008 recession, in the United States and Western Europe has been linked to the so-called subprime mortgage crisis. Subprime mortgages are home loans granted to borrowers with poor credit histories. Their home loans are considered high-risk loans. With the housing boom in the United States in the early to mid-2000s, mortgage lenders seeking to capitalize on rising home prices were less restrictive in terms of the types of borrowers they approved for loans. And as housing prices continued to rise in North America and Western Europe, other financial institutions acquired thousands of these risky mortgages in bulk, typically in the form of mortgage-backed securities, as an investment, in hopes of a quick